Mr. Buffett, I'm Lee Miller from St. Louis. There was an article in the April 18th Barron's that attempted to calculate the value behind each Berkshire Hathaway share. I'm sure you have some views on that, and I'd be very interested in your perspective on that issue.
Yeah, there was an article about a week or so ago in Barron's. The same fellow wrote an article about 4 years ago reaching pretty much the same conclusion, and I hope he hasn't been short in between, but I would say this, it is not the way I would calculate the intrinsic value of Berkshire, but everyone in securities markets makes choices on that. Every day somebody sells a few shares of Berkshire and someone buys, and they are probably coming to differing opinions about valuation. I would say that I found it strange that apparently he forgot we were in the insurance business, but that's not total. It really doesn't make any difference. I mean, we don't pay any attention to what people say about Coca-Cola stock or Gillette stock or any of those things. I mean, on any given day, 2 million shares of Coca-Cola may trade. That's a lot of people selling, a lot of people buying it. If you talk to one person, you'd hear one thing, and talk to another. You really should not make decisions in securities based on what other people think. If you're doing that, you should think about doing something else, because a public opinion poll will not get you rich in Wall Street. So you really want to stick with businesses that you feel you can somehow evaluate yourself. And Charlie and I, we don't read anything about what the economy is going to do, or the market's going to do, or what anytime I see some article that says, these analysts say this or that about some business, it doesn't mean anything to us. You cannot get rich with a weather vane. Zone 7.
Thank you for teaching so much to all of us about business. My name is Mike Assail from New York City. You mentioned earlier that Berkshire's shoe business was great, but that other shoe businesses were not so good. What are the uncertainties of the global brand leaders that the Berkshire seems to like? They like Coke and Gillette. The global brand leaders in the shoe business being Nike and Reebok. What are their uncertainties in terms of long-term competitive advantage, business economics, consumer behavior, and the other risk factors that you mentioned in the annual report this year? Thank you.
So you're really asking about the future prospects of Nike and Reebok? Yeah, I don't know that much about those businesses. We do have one person in this audience at least who owns a lot of Reebok, but I'm not expressing a negative view in any way on that. I don't understand their competitive position and the likelihood of permanence of their competitive position over a 10 or 20-year period, as well as I think I understand the position of Brown and Dexter. That doesn't mean I think that it's inferior. It doesn't mean that I think that we've got better businesses or anything. I think we've got very good businesses, but I haven't done the work, and I'm not sure if I did the work I would understand them. I think they are harder to understand, frankly, and to develop a fix on than our kinds. But they may be easier for other people who just have a better insight into that kind of business. Some businesses are a lot easier to understand than others. And Charlie and I don't like difficult problems. I mean, if something is hard to figure, we'd rather multiply by 3 than by pi. I mean, it's just easier for us. Charlie,
Well, that is such an obvious point, and yet so many people think if they just hire somebody with the appropriate labels, they can do something very difficult. That is one of the most dangerous ideas a human being can have. All kinds of things just intrinsically create problems. The other day I was dealing with a problem, and I said, it's a new building. And I said, this thing has 3 things I've learned to fear: an architect, a contractor, and a hill. And if you go at life like that, I think you at least make fewer mistakes than people who think they can do anything by just hiring somebody with a label.
Excuse me, go ahead, sir.
You don't have to hire out your thinking if you keep it simple.
You don't have to do, we've said this before, but you don't have to do exceptional things to get exceptional results. And some people think that if you jump over a 7-foot bar, that the ribbon they pin on you is going to be worth more money than if you step over a 1-foot bar. And it just isn't true in the investment world at all. So you can do very ordinary things. I mean, what is complicated about this? But, you know, we're $3 billion pre-tax better off than we were a few years ago because of it. There's nothing that I know about that product or its distribution system, its finances, or anything that really hundreds of thousands or millions of people aren't capable of, that they don't already know. They just don't do anything about it. And similarly, if you get into some complicated business, you can get a report that's 1,000 pages thick, and you got PhDs working on it, but it doesn't mean anything. You know, what you've got is a report, but you won't understand that business, what it's going to look like in 10 or 15 years. The big thing to do is avoid being wrong.
There's some things that are so intrinsically dangerous. Another of my heroes is Mark Twain, who looked at the promoters of his day, and he said, "A mine is a hole in the ground owned by a liar." And that's the way I've come to look at projections. I mean, basically, I can remember Warren and I were offered $2 million worth of projections once in the course of buying a business, and the book was this thick. And
for nothing.
And we were given it for nothing, and we wouldn't open it.
You know, we'd almost pay $2 million not to look at it. I mean, it's ridiculous. I do not understand why any buyer of a business looks at a bunch of projections put together by a seller or
his agent.
Or his agent. I mean, you can almost say that it's naive to think that that has any utility whatsoever. We just are not interested. If we don't have some idea ourselves of what we think the future is, to sit there and listen to some other guy who's trying to sell us the business or get a commission on it, tell us what the future is going to be, like I say, it's very naive.
Yeah, and 5 years out.
Yeah. We had a line in the report one time, "Don't ask the barber whether you need a haircut." And it's quite applicable to projections by sellers of businesses.
Diane West from Corona Del Mar, California. I know, Mr. Buffett, that you've said that you don't read what other people say about the market or the economy, but do either you or Charlie have an opinion about how you think things are going to go? Are you bullish or bearish?
You may have trouble believing this, but Charlie and I never have an opinion about the market because it wouldn't be any good, and it might interfere with the opinions we have that are good. If we're right about a business, if we think a business is attractive, it would be very foolish for us to not take action on that because we thought something about what the market was going to do or anything of that sort, because we just don't know. And to give up something that you do know and that is profitable for something that you don't know and won't know because of that, it doesn't make any sense to us, and it doesn't really make any difference to us. I mean, I bought my first stock, I think, in probably April of 1942 when I was 11. And since then, I mean, actually World War II didn't look so good at that time. I mean, the prospects, they really didn't. I mean, we were not doing well in the Pacific, and I'm not sure I calculated that into my purchase of my 3 shares. But I mean, just think of all the things that have happened since then, you know, atomic weapons and major wars and presidents resigning and all kinds of things, massive inflation at certain times. To give up what you're doing well because of guesses about what's going to happen in some macro way just doesn't make any sense to us. The best thing that can happen from Berkshire's standpoint, we don't wish this on anybody, but over time, is to have markets that go down a tremendous amount. I mean, we are going to be buyers of things over time. Now, if you're going to be buyers of groceries over time, you like grocery prices to go down. If you're going to be buying cars over time, you like car prices to go down. We buy businesses. We buy pieces of businesses, stocks. And we're going to be much better off if we can buy those things at an attractive price than if we can't. So we don't have any fear at all. I mean, what we fear is an irrational bull market that's sustained for some long period of time. You as shareholders of Berkshire, unless you own your shares on borrowed money or are going to sell them in a very short period of time, are better off if stocks get cheaper, because it means that we can be doing more intelligent things on your behalf than would be the case otherwise. But we have no idea and we wouldn't care what anybody thought about it. I mean, most of all ourselves. I mean, Charlie, do you have any?
No, I think if you're agnostic about those macro factors and therefore devote all your time to thinking about the individual businesses and the individual opportunities, it's a way more efficient way to behave, at least with our particular talents and lacks thereof.
If you're right about the businesses, you'll end up doing fine. We don't know, and we don't think about when something will happen. We think about what will happen. It's not so difficult to figure out what will happen. It's impossible in our view to figure out when it will happen. So we focus on what will happen. This company in 1890 or thereabouts, the whole company sold for $2,000. It's got a market value now of about 50-odd billion. You know. Somebody could have said to the fellow who was buying this in 1890, you know, you're going to have a couple of great world wars, and you know, and you'll have the panic of 1907. All these things will happen. And wouldn't it be a better idea to wait? You know? We can't afford that mistake, basically. Yeah. Zone 3.
Hello. My name is Charles Pyle from Ann Arbor, Michigan. I'd like to ask you to expound on your view of risk in the financial world. And I ask that against the background of what appear to be a number of inconsistencies between your view of risk and the conventional view of risk. I mentioned that in a recent article you pointed out an inconsistency in the use of beta as a measure of risk, which is a common standard. And I mentioned that derivatives are dangerous, and yet you feel comfortable playing in derivatives through Salomon Brothers, and betting on hurricanes is dangerous, and yet you feel comfortable playing with hurricanes through insurance companies. So it appears that you have some view of risk that's inconsistent with what would appear on the face of it to be the conventional view of risk.
Well, we do define risk as the possibility of harm or injury, and in that respect, we think it's inextricably wound up in your time horizon for holding an asset. I mean, if your risk is that if you intend to buy XYZ Corporation at 11:30 this morning and sell it out before the close today, I mean, that is, in our view, that is a very risky transaction, because we think 50% of the time you're going to suffer some harm or injury. If you have a time horizon on a business, we think the risk of buying something like Coca-Cola at the price we bought it at a few years ago is essentially so close to nil in terms of our prospective holding period. But if you ask me the risk of buying Coca-Cola this morning and you're going to sell it tomorrow morning, I say that's a very risky transaction. Now, as I pointed out in the annual report, it became very fashionable in the academic world, and then that spilled over into the financial markets, to define risk in terms of volatility, of which beta became a measure. But that measure, that is no measure of risk to us. The risk in terms of our supercat business is not that we lose money in any given year. We know we're going to lose money in some given day, that is for certain, and we're extremely likely to lose money in a given year. Our time horizon of writing that business, would be at least a decade, and we think the probability of losing money over a decade is low. So we feel that in terms of our horizon of investment, that is not a risky business, and it's a whole lot less risky than writing something that's much more predictable. Interesting thing is that using conventional measures of risk, something whose return varies from year to year between plus 20% and plus 80% is riskier as defined than something whose return is 5% a year every year. We just think the financial world has gone haywire in terms of measures of risk. We look at what we do. We are perfectly willing to lose money on a given transaction, arbitrage being an example, any given insurance policy being another example. We are perfectly willing to lose money on any given transaction. We are not willing to enter into transactions in which we think the probability of doing a number of mutually independent events but of a similar type has an expectancy of loss. And we hope that we are entering into our transactions where our calculations of those probabilities have validity. And to do so, we try to narrow it down. There are a whole bunch of things we just won't do because we don't think we can write the equation on them. But we basically, Charlie and I, by nature, are pretty risk averse, but we are very willing to enter into transactions. If we knew it was an honest coin and someone wanted to give us 7 to 5 or something of the sort on one flip, how much of Berkshire's net worth would we put on that flip? Well, we would. It would sound like a big number to you. It would not be a huge percentage of the net worth, but it would be a significant number. We will do things when probabilities favor us. Charlie?
Yeah, I would say we try and think like Fermat and Pascal, as if they'd never heard of modern finance theory. I really think that a lot of modern finance theory can only be described as disgusting.
Zone 6?
Hello, I'm Christopher Davis from New York City. I'm interested in that many of the holdings of Berkshire are in industries that are perceived as interest rate sensitive industries, including Wells Fargo, Solomon, Freddie Mac, even Geico. And yet you have an admitted sort of ambivalence towards interest rates or changes in interest rates, and it therefore seems that you don't feel that those changes affect the fundamental attractiveness of those businesses. I thought maybe you could share your thoughts on what you see in these businesses that the investment community as a whole is ignoring.
Well, the value of every business, the value of a farm, the value of an apartment house, the value of any economic asset is 100% sensitive to interest rates, because all you are doing in investing is transferring some money to somebody now in exchange for what you expect a stream of money to come in over a period of time. And the higher interest rates are, the lower the present value is going to be. So every business by its nature, whether it's Coca-Cola or Gillette or Wells Fargo, is in its intrinsic valuation is 100% sensitive to interest rates. Now the question as to whether a Wells Fargo or a Freddie Mac or whatever it may be, whether their business gets better or worse internally as opposed to the valuation process because of higher interest rates, that is not easy to figure. I mean, Geico, if they write their insurance business at the same underwriting ratio, in other words, they have the same loss and expense experience relative to the premiums, they benefit by higher interest rates, obviously, over time, because they're a float business and the float is worth more to them. Now, externally, getting back to the valuation part, the present value of those earnings also becomes less then, but the present value of Coke's earnings becomes less in a higher interest rate environment. Wells Fargo, it's whether they earn more or less money under any given interest rate scenario is hard to figure. there may be one short-term effect and there may be another long-term effect. So I do not have to have a view on interest rates, and I don't have a view on interest rates, to make a decision as to an insurance business or a mortgage guarantor business or a banking business or something of the sort relative to making a judgment about Coke or Gillette. Charlie?
I've got nothing to add.
Zone 2?
We're reading about various analysts and how you should, in their individual opinion, adjust your more cash, more stocks, more bonds because of. How does Berkshire Hathaway feel about times of relative financial insecurity? Do you arrange for more cash reserves, looking forward to a time when you might be able to buy, or do you go along your path?
I think the question is, do we get into asset allocation by maintaining given levels of cash depending on some kind of outlook or something of the sort? We don't really think that way at all. If we have cash, it's because we haven't found anything intelligent to do with it that day in the way of buying into the kind of businesses we like. And when we can't find anything for a while, the cash piles up. But that's not through choice. That's because we're failing at what we essentially are trying to do, which is to find things to buy. And we make no attempt to guess whether cash is going to be worth more 3 months from now or 6 months from now or a year from now. So it is, you will never see, we don't have any meetings of any kind anyway at Berkshire, but we would never have an asset allocation meeting. We would keep looking. I mean, Charlie's looking, I'm looking, some of our managers are looking. We're looking for things to buy that meet our tests. And if we showed no cash or short-term securities at year-end, we would love it because it would mean that we'd found ways to employ the money in ways that we like. I think I would have to admit that if we have a lot of money around, we are a little dumber than usual. I mean, it tends to make you careless. And I would say that the best purchases are usually made when you have to sell something to raise the money to get them, because it just raises the bar a little bit that you jump over in the mental decisions. But we have, I don't know what we'll show, but certainly well over $1 billion of cash around, and that's not through choice. That is that you can look at that as an index of failure on the part of your management. And we will be happy when we can buy businesses or small pieces of businesses that use up that money. Zone 4.